These are the transactions for problem 6.5. Our first transaction on January 1st, the owner invested $12,000 in the business. The business received the cash, so we debit the asset cash in bank for $12,000, and it's the owner investment, so it's Regina Delgado Capital. That's an owner's equity account with a normal credit balance, increases with the credit of $12,000. Debit cash in bank, $12,000, credit Regina Delgado Capital, $12,000, and our source document is Memorandum 41. Transaction on the 5th, we bought office furniture on account. We didn't have the asset office furniture before. We now have it, so that increases the asset account office furniture with a debit. We didn't pay cash for it, so there's no credit to cash in bank. It was on account, so we credit accounts payable. That's when we owe someone O'Brien's Office Supply for $5,000. Accounts payable liability increases with a credit, so we now owe $5,000 to O'Brien's Office Supply. Debit office furniture, $5,000 credit. Accounts payable, O'Brien's Office Supply, $5,000. Our source document is Brian's Office Supply invoice, $1,632. Transaction on the 8th, we provided a service and received cash. So we know when we receive cash, we debit the asset cash in bank. It increased, so we debit cash in bank, $1,600. Why did we receive that cash? We provided a service. We know that's wash revenue. Revenue accounts have a normal credit balance, so it increased by $1,600. Our source document receipt 101. Transaction on the 10th, we paid cash for advertising expense. So this is an expense for cash transaction. We're debiting the expense account. Advertising expense has a normal debit balance, increases with a debit. We paid cash, so we know we credit the asset account, cash in bank. The asset account, cash in bank, decreases with a credit. Debit advertising expense, $75. Credit cash in bank, $75. Source document check, 301. On the 13th, Regina Delgado took money from the business. We know that she wrote a check. We know that decreases cash in the bank. So the owner withdraws account, an owner's equity account has a normal debit balance. It increases with a debit, decreases with a credit. So we debit Regina Delgado withdraws, $900. Credit cash in bank, $900. And our source document is check 302. On the 17th, we provided a service on account. Keyword is on account. We provided a service. So Valley Auto owes us $400. Accounts receivable, Valley Auto has a normal debit balance, increases with a debit, decreases with a credit. So we provided a service for them. They didn't pay us cash, so they owe us $400, debiting accounts receivable, Valley Auto. We provided a service for them. That's our revenue account. Revenue accounts have a normal credit balance, increase with a credit, decrease with a debit, so we credit interior detailing revenue for the $400. So our sales invoice 102 is our source document. On the 18th, we made payment on account. We know cash in bank is the credit. We decrease cash in bank. So why did we write that check? We're paying O'Brien's Office Supply $2,500. Accounts payable has a normal credit balance, so we want to decrease what we owed. We're paying them back. We decrease accounts payable with a debit, so we debit accounts payable, O'Brien's Office Supply $2,500, crediting cash in bank $2,500. Our source document is check 303. On the 20th, the owner invested some office equipment in the business. So we debit the office equipment account that we didn't have before. Debiting office equipment $350. It's an increase to the asset. We're also increasing the owner's claims to what the owner has. Regina Delgado Capital. Owner's equity account has a normal credit balance, so it increased. We didn't have that office equipment before. and the owner has the full claims to that asset, so we increase the capital by $350. Source document memorandum 42. On the 22nd, we paid rent. We wrote a check, so we're debiting the expense account, rent expense, normal debit balance, increases with a debit, decreases with a credit. Cash and bank is the asset account. We wrote a check. We know we decrease cash and bank with a credit. The asset account, cash and bank, is decreased with a credit. Debit rent expense $600. Credit cash and bank $600. Source document check 304. On the 24th, we purchased car wash equipment on account. We didn't have car wash equipment before, so we increased the asset account. Car wash equipment $1,500. We didn't pay cash, but we owe Allen Vacuum Systems $1,500. Accounts payable, the liability, a normal credit balance, increases with the credit, decrease with a debit. So we're increasing what we owe to Allen Vacuum Systems, $1,500. Our invoice, Allen Vacuum Systems invoice, $312. On the 26th, we received cash from Valley Auto. Why did we receive that cash? They're making payment on account. We received cash right away. Debit, cash and bank. We increase cash and bank with a debit, but we have to decrease what is owed to us from Valley Auto. Accounts receivable, Valley Auto is decreased with a credit, $400. They paid back money that was owed to us. Debit, cash, and bank, $400. Decrease accounts receivable with a credit. Accounts receivable, Valley Auto, $400. Source document, receipt 102. And on the 30th, we made payment on account. We're paying back O'Brien's Office Supply $2,500. So accounts payable, O'Brien's Office Supply has a normal credit balance. We're making payment on account, so we're decreasing what we owe. We decrease the liability, accounts payable, with a debit. We wrote a check, so we know we credit cash and bank. Cash and bank has a normal debit balance. The asset account is decreased with a credit. So it's debit, accounts payable, O'Brien's Office Supply, $2,500, and credit cash and bank, $2,500. Source document check 305. And the amount of the total assets of Hot Suds Car Wash on January 31st is $14,275.